Hey, what's up? What we're talking about today is the economy and the fact that a recession hasn't even started yet. You might have seen the stock market crash, which happened, 35% drop. It was insane, really unexpected. But what we've been talking about for a long time now, especially in all my videos, is how there is going to be a recession that comes based on a number of big factors. And one of those big factors is consumer spending. And so when we think about what leads to a recession in the first place is a drop in consumer spending. What I'm basically saying is we're about to go into a recession. As predicted in some of my earlier videos, I thought we would see this happen around May 2020. We're approaching May 2020, and it can be really confusing right now because we just saw this huge dip and now the stock market is recovering. However, the liquidity crisis that happened was very much in the financial markets, and the oil crisis that is happening is very much wrapped around a lot of different things like futures contracts in the USO. So what we really need to start thinking about is fundamentally what's happening in the economy that could potentially lead to what they say is a W or a second dip. I don't even think of it that way. I think of it as the true recession that we've been waiting for 12 plus years now, since essentially 2008. What that means for us as investors, as individuals who are in the 25 to say 40 year range who are looking to accumulate wealth, is we need to think smart about how we deploy our capital going forward. You may remember from my previous videos that I was completely sold out of the market as early as September 2018. I've been 100% liquid since then. I'm still over 90% liquid right now. So yeah, you could say, oh, I missed the bottom where it went down 35%. But you know, pandemics notwithstanding, looking at the fundamentals of where the economy is right now, we haven't even had earnings reports come in for several, as many as 3, 4, 5 different quarters to indicate which sectors are actually impacted right now. And so when I roll this back again and we're trying to really understand kind of what's going to happen going forward, I actually expect in the next 3 to 6 months for there to be a real recession. Now, I'm not calling a bottom. I'm not trying to time the market here, even though if you know me, I am timing the market. Don't do that. Don't do what I do. If I was you, I'd dollar cost average over time, index in the S&P 500, 10.9% with dividends reinvested, and you're going to be free and clear. However, my bold prediction is very straightforward. We are going into a recession. What we saw before was a huge panic in the market. Very wealthy investors sold off very quickly to get ahead of what they thought was going to be a very, very bad crash in the economy. They said depression, they said recession. And then a lot of retail investors have been buying up the market recently. People that never thought they could buy stocks before, they're investing in Robinhood, and I think that's super awesome. However, I'm really concerned about those investors who think the market is actually going to rebound from here. I'm not sure what that noise was. And going forward, they're expecting a long-term win. I'm encouraging all my friends and family to basically rebalance their portfolios and get out of bonds right now, get into equities. If they had exposure to bonds, great, because that really protected them on the downside. However, going forward, I'm expecting bond prices to go down and yields to go up. So that means we got to get out of bonds, we got to get into equities. But overall, if it's in a 401k or an IRA, just play it safe. Maybe you don't want to do your target date fund 2055. Maybe you want to just simply invest in something that tracks the S&P 500, slightly more aggressive, but still extremely conservative. That's what I'd recommend for that type of investing. However, for me, as we go forward into what I would consider a real recession, as this pandemic subsides and we find ways to work through it, we're going to actually now see that what we've expected for a long time is there's going to be a lot of profit taking from the wealthy investors. A lot of the big businesses had a lot of debt on their balance sheet, and they're going to be exposed now. Whether it was a pandemic, which we could have never predicted, and that wasn't the fact that it timed right as I said the market was going to crash, is just purely coincidence. But what isn't coincidence is that corporations in America and valuations of equities in the stock market have been very, very high for a long time, and they were due for a pullback. And so the trigger came, and it was a huge trigger, and we saw that massive shock down, and then we rebounded quickly. And I think it's fair, and we can think about that the market has everything priced perfectly, meaning everything that we know is disseminated instantly into the markets. And that's why the markets rebounded so quickly. It's because the recession hasn't started yet. So if we could just erase that big crash, like it never happened, I think we would actually be looking at what could be the start of a recession, as we saw the peak and towards the beginning of the year, around mid-February. And then from that peak, if you drew a line to where we are now, Dow 24,000, about there, not Dow 18,000. If you draw a trend line through that, that's more realistically where the real economy's been the whole time. And now going forward, we can say, have we felt any impact of a real recession yet? No, not really. Putting the pandemic aside, we've endured as much as 4 to 6 weeks unemployment for a subsection of workers in America. Furloughs have happened for a subsection of employment in America. Unemployment is spiked temporarily. So none of these things are actually indicative of a recession. These are indicative of a pandemic, which will go away, but then we're going to have to really pick up the pieces and say, all right, our company is going to be running the same way. And essentially, I don't want to say this is the excuse that the ultra wealthy classes and the corporations have been waiting for, but now is as good a time as any to actually clean up the balance sheets, to take profits out of equities, de-risk portfolios, and really, if you take a look at Berkshire Hathaway, for example, tons and tons of cash ready to deploy, been waiting to purchase value for a long, long time. And that's exactly what's going to happen. So you're going to hear me talking a lot about Berkshire Hathaway. We're going to be keeping our eye on Warren, seeing what he's going to do with his cash. And from there, we're going to start talking more frequently about the coming recession that hasn't started yet, and how it's going to affect the different segments of the market. All right, I'll see you next time.